you know, the world compounds very fast. Banking as a whole has earned at rates that are well beyond. The commercial banks earn between 12% and 16% or so on net tangible assets. That's a good business. It's a fantastic business against the long-term bond, at 2%.
Did you know that Warren Buffett's Berkshire Hathaway saw a staggering 20.3% annual growth from 1965 to 2020, compared to the S&P 500's 10.2%? Or that Buffett turned a failing textile mill into a $700 billion company? These incredible numbers are more than just numbers. They show you how smart Buffett is as an investor. Today, we're going to tap into that wisdom. We'll guide you through a Buffett-inspired strategy to potentially grow your investment from $10,000 to $100,000 in a few years. Let's look at how disciplined investing can make something that seems almost impossible possible over time.
Investing is really not complicated. I mean, the basic framework for it is simple. Now then you have to work.
So let's first talk about the fundamental aspect of Warren Buffett's investment strategy: saving and investing wisely. Buffett, known for his smart financial habits, emphasizes the importance of saving as the first step towards successful investing. He famously advises, do not save what is left after spending, but spend what is left after saving. If you start with $10,000 and manage to save an additional $500 every month, in 1 year you will have saved $6,000. Over 3 years, that's an additional $18,000, bringing your total to $28,000 without accounting for any investment returns. Now, let's apply Buffett's principle of investing to these savings. If you invest this amount in a diversified portfolio with an average annual return of 7%, which is a realistic figure based on historical market performance, your investment will grow each year. For example, your $10,000 investment goes up to $10,700 in the first year. Adding your yearly savings, you start the second year with $16,700. By continuously saving and investing, your initial $10,000 can grow substantially over a few years. Buffett's approach to saving and investing is not just about accumulating wealth, it's about financial discipline. He advocates for living within your means and investing the surplus. Sticking to this plan for saving and investing is important for getting big returns on your money. Additionally, Buffett stresses the importance of being informed about your investments. It's not enough to just save and invest. Understanding where and how to invest is essential. This means doing your research, whether it's in stocks, bonds, or mutual funds, and making informed decisions. After establishing a solid foundation through savings, the next step in Warren Buffett's strategy is intelligent and informed investing. It's all about logical thinking. This is what Buffett says about following logic.
You really just had to have sort of the courage of your convictions. You had to have the willingness to do something when everybody else was petrified.
Buffett's success is largely attributed to his ability to pick stocks that offer not just good returns, but phenomenal growth over time. Let's break down how you can apply this to your investment journey. Buffett believes in studying and understanding the market for a long time. He looks for companies with a competitive advantage, strong leadership, and a track record of profitability. For example, when Buffett started buying shares of Coca-Cola in 1988, he focused on its brand strength and global market presence. Today, Coca-Cola is a prime example of a successful long-term investment, with its stock price increasing multiple times over the decades. To apply Buffett's principles, start by researching companies that show potential for long-term growth. Look at their financial health, market position, and growth prospects. For example, if you invest in a company with a stock price of $50 and an annual growth rate of 10%, your investment will grow year over year. If you invest $5,000 in such a stock, in the first year, your investment would grow to $5,500. Buffett's investment strategy heavily relies on the power of compound interest. By reinvesting the returns of his investments, he was able to significantly increase the value of his initial capital. For example, if your $5,000 investment grows at $10,000 annually and you reinvest the returns, in 10 years, your investment would be worth over $12,968. This shows the power of compound interest over time.
The lesson of following logic rather than emotion, is something that's obvious, and some people have great trouble with it and others have less trouble.
Buffett may be known for his significant bets on certain companies, but he also understands the value of diversification. By spreading your investments across different sectors and asset classes, you reduce risk and ensure a more stable return on your investments. For example, if you diversify your portfolio across tech stocks, consumer goods, and healthcare, you're not overly reliant on one sector's performance. Buffett's approach to investing also involves careful risk management. He avoids investments that he doesn't understand and focuses on maintaining a balanced portfolio. This means not putting all of your eggs in one basket and being prepared to adjust your investments based on market changes. Now that you have $28,000 saved up and want your investment to grow significantly over the next 3 years, let's do some math to see how it can do that. We will take this path, assuming a 10% average growth rate in a diversified portfolio and adding savings annually. Here's how it unfolds. In the first year, you begin with $28,000. With a 10% growth rate, this investment grows by $2,800, bringing your end-of-year total to $30,800. It's a solid start, showing the initial fruits of your investment strategy. Moving into the second year, you're not just relying on the previous year's growth. You add an additional $6,000 from your savings to the pot, increasing your investment to $36,800. Applying the same 10% annual growth rate, you gain another $3,680 by the year's end. Now your investment stands at $40,480. You're gaining momentum, seeing your strategy start to pay off more significantly. As you enter the third year, your strategy continues. You add another $6,000, boosting your total investment to $46,480. With the market still favoring you at a 10% growth rate, you earn $4,648 this year. By the end of the third year, your total investment will have grown to $51,128. It's a substantial increase from your initial $28,000, showcasing the power of consistent saving and investing. But let's not forget that the market can be unpredictable. If the market dips and your growth rate falls to, say, 5%, your returns would be lower. Conversely, in a booming market, you might see higher returns. This process, it's not just about numbers. It's about adapting to market changes and understanding the importance of diversification to balance out all these fluctuations. And we must account for inflation. Your nominal returns might look great on paper, but the real value depends on the inflation rate. To know how much your investment has grown, you need to look at the real rate of return. Intelligent and informed investing, following Buffett's principles, it's more about just picking stocks. It's about understanding the market, managing risks, and being patient with your investments. By applying these principles, you could significantly increase your chances of turning your $10,000 into $100,000. Now let's talk about the third important part of Warren Buffett's plan to turn $10,000 into $100,000, using the power of compound interest. Buffett famously said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." This step is all about understanding and utilizing this financial phenomenon to its fullest potential. Compound interest is essentially interest on interest. It is the result of reinvesting your earnings rather than paying them out, so that in the next period, you earn interest on both your initial principal and the accumulated interest from previous periods. This can lead to exponential growth in your investment over time. Let's say you followed the first two steps and you have an investment portfolio that is now worth $51,128. If you continue to reinvest your earnings and achieve a consistent 10% annual return, your investment will not just grow by a fixed amount each year, but by increasing amounts. In the fourth year, your $51,128 investment would grow by 10%, adding approximately $5,113 to your portfolio, bringing the total to around $56,241. The following year, that 10% growth applies to the new total, and so on. This compounding effect accelerates the growth of your investment significantly over time. Buffett's approach has always been to reinvest his returns. He looks for investments that not only offer good returns, but also the opportunity to reinvest those returns to generate more wealth. This could mean reinvesting dividends from stocks, profits from business ventures, or interest from bonds. Continuing with our example, if you keep reinvesting your returns at a 10% growth rate, your investment would continue to grow exponentially. By the end of the 5th year, your portfolio could be worth approximately $62,165. And in the 6th year, it could grow to around $68,272. However, it's important to remember that these calculations assume a consistent return rate, which might not always be the case in the real-world market conditions. Diversification, as discussed earlier, can help manage this risk. As we move into the 4th step in Warren Buffett's approach to growing wealth, we focus on the crucial concept of diversification. Buffett himself, despite often being associated with big bets on companies like Coca-Cola and Apple, has always stressed the importance of not putting all of your eggs in one basket. Diversification is about spreading your investments across various assets to reduce risk and ensure more stable returns. Let's say your investment portfolio, now worth around $68,272 after applying the first 3 steps, includes stocks, bonds, and perhaps some real estate or mutual funds. The idea is to have a mix of these assets because they usually don't move in the same direction. When one asset class is down, another may be up, balancing your portfolio's performance. For example, if the stock market faces a downturn, your bonds or real estate investments might still hold their ground or even appreciate, cushioning the impact of your portfolio. This balance is what helps maintain steady growth over time, despite the market's ups and downs. Continuing with our example, if you diversify your $68,272 investment across different asset classes, let's assume an overall average growth rate of 8%, considering some assets might grow more than others. By the end of the 7th year, your investment could potentially grow to around $93,000, factoring in the added stability and reduced risk that come with diversification. The 5th and final step to getting your $10,000 investment to $100,000 in a few years is probably the most important. Be patient and keep an eye on the long term.
If we could see in it, looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value.
Buffett famously said, "The stock market is designed to transfer money from the active to the patient." This step is about understanding the value of time in investing and the importance of sticking to your long-term goals. Patience in investing means resisting the urge to react hastily to market fluctuations and maintaining your investment strategy even during downturns. It's about being able to look past short-term changes and focus on long-term growth opportunities. Let's consider your diversified portfolio, which is now potentially worth around $93,000. The key to growing this further is not to be swayed by short-term market trends, but to keep your eyes on the long-term prize. This means continuing to invest wisely, reinvesting your returns, and staying committed to your diversified portfolio, even if the market seems to be moving against you at times. Buffett's investment choices are not based on what he thinks will happen in the market tomorrow, next week, or even next year. He chooses companies that he believes will perform well over the next decade or more. This long-term approach reduces the urge to make impulsive decisions based on short-term market movements. If you continue to follow this long-term approach, maintaining an average annual growth rate of 8% and reinvesting your returns, Your portfolio could potentially exceed your $100,000 target in the next year or so. If the growth rate is 8%, your $93,000 investment could grow to around $100,440 by the end of the 8th year. Patience and long-term vision are essential to following Buffett's path to financial success. It's about staying the course, trusting your investment strategy, and understanding that true wealth is built over time. How do you plan to incorporate patience and long-term thinking into your investment strategy? Share your thoughts on how you'll stay focused on your long-term financial goals in the comments below.